Welcome to CoreLogic's housing market update for February 2024, brought to you by First National Real Estate. Australia's housing upswing continued through the first month of 2024, with CoreLogic's National Home Value Index rising by 0.4% in January. That was up from the 0.3% increases seen in November and December, and it marks the 12th straight month of value rises. Beneath the headline result, housing trends remain diverse around the country. Melbourne, Hobart and the ACT all recorded a subtle decline over the month, while Perth, Adelaide and Brisbane values continue to rise at the monthly rate of 1% or more. The remaining capital cities recorded relatively flat conditions over the month. House values continued to rise at a faster rate than unit values in January, with the gap between the median capital city house and unit value rising to a record high of 45.2%. Such a wide gap is the result of house values recording more than 3 times the capital gain of units since the onset of the pandemic. Since March of 2020, capital city house values have surged by 34%, compared with an 11% rise across the unit sector. This trend continued in January, with house values up 0.5% over the month, adding around $4,800 to the median house value, while units increased by a small 0.1%, equivalent to a $900 lift. It seems that most Australians are willing to pay a higher premium than ever for a detached home. Regional markets are now showing a stronger trend in value growth relative to the capital cities. The combined regional index rose by 1.2% over the rolling quarter, compared with a 1% rise across the combined capitals index. Both the combined capitals and the combined regionals markets are losing momentum in the pace of value growth, but the capital city trend is experiencing a sharper slowdown, mostly due to the flattening of growth conditions in Melbourne and Sydney. Across the other states, regional WA, South Australia and Queensland continue to record a slower pace of growth relative to their capital city counterparts. These are also the 3 regional markets where dwelling values are at record highs. Despite worsening housing affordability, the volume of home sales has held slightly above average over the past 3 months. CoreLogic estimates there were over 115,000 dwellings sold over the 3 months ending January, 11.9% higher than at the same period last year and 0.5% above the previous 5-year average for this time of the year. Although households are dealing with ongoing cost of living pressures, high interest rates, low consumer sentiment and affordability constraints, homes are still selling. Housing demand has been buoyed by high migration, but also by tight rental markets that have probably incentivized renters to transition towards home ownership if they can afford to do so. The trend in Sydney housing values has virtually stabilized over the past 3 months, with the market up 0.1% over the rolling quarter, but 11.4% higher over the past 12 months. The annual rise has been much stronger for houses than units, with values up 12.8% and 7.7% respectively. The annual rise has added about $158,000 to the median house value and $59,000 to the median unit value. With housing affordability becoming more pressing and such a substantial gap between house and unit values, we could see more demand deflected towards the medium to high density sector, where unit values, based on the median, are nearly $570,000 lower relative to houses. The housing market has started the year on a similar footing to where it left in 2023, with values generally trending higher, albeit with significant diversity across the regions and the housing types. The key factors shaping the outlook for 2024 are also diverse, with the path of inflation, interest rates, credit policy, consumer sentiment and demographic trends central to the direction of housing markets. Inflation has been moderating since moving through an annual 7.8% peak in 2022, falling to 4.1% in December last year, beating the RBA's forecast of 4.5% inflation. The expectation is that CPI will continue to trend lower, and there's a pretty good chance it will beat the RBA's forecast by the middle of the year. Lower inflation should help to bring down the cash rate, but also provide some support for consumer sentiment as cost of living pressures subside. The cash rate looks to have peaked at 4.35%, well above the pre-COVID decade average of 2.55%. A loosening in monetary policy settings is likely to be a cautious and gradual process, with most forecasts indicating the cash rate will reduce by 25 basis points towards the end of the year, with a further moderation of rates in 2025. While lower interest rates will improve borrowing capacity and help to lift sentiment, we would need to see the cash rate drop by almost 1.8 percentage points, equivalent to more than 7 standard 25 basis point cuts, before rates return to the pre-COVID decade average. Credit policy and macroprudential settings could be a key determinant of housing outcomes in 2024. One of the biggest hurdles in the way of a material lift in home purchasing demand is the 3 percentage point buffer applied to a borrower's home loan serviceability assessments. Potentially, we could see APRA adjust the buffer back to its previous setting of 2.5% as interest rates fall. However, there's no guarantee this will be the case. Holding the serviceability buffer at the current setting of 3 percentage points could provide APRA with some assurance of reduced credit risk. Although housing outcomes are outside of APRA's mandate, holding the serviceability buffer firm or pulling other policy levers, such as loan-to-income ratio or debt-to-income ratio limits, could minimise the chance of a home price surge as interest rates fall. Consumer sentiment has been in deeply pessimistic territory since mid-2022. High cost of living pressures and high interest rates have been influential in keeping sentiment close to recessionary lows. Historically, there's been a strong correlation between consumer confidence and home purchasing activity. Although this relationship has diverged a little bit in 2023, which is probably attributable to high migration and unusually tight rental conditions, any lift in consumer attitudes should play out positively for housing market activity. With inflation easing and the prospect of rate cuts later this year, we should eventually see sentiment improving. Migration patterns are clearly changing, with a peak in overseas migration last year, a normalization in regional migration patterns, and an easing in some of the more extreme interstate movements. Less overseas migration should help to ease rental demand, especially in the largest capitals where a higher portion of overseas migrants have settled historically. From a purchasing perspective, there is a lag in home buying activity from permanent migrants, suggesting we're likely to see the recent peak levels of migration flow through to purchasing activity over the coming years. From a supply perspective, the new housing sector remains challenging. Although the trend in dwelling approvals looks to have found a floor, approvals remain well below average levels and nowhere near the level required to achieve the government's target of 1.2 million well-located new homes over the next 5 years. Although construction costs are now rising at a below-average pace, the previous surge in building costs has created significant margin pressures for the sector, and labour supply remains scarce. The burgeoning undersupply of newly built homes is likely to keep a floor under housing values over the medium term at least. The housing sector will be closely watched this year as policymakers grapple with affordability pressures and getting more housing supply underway. The prospect of lower cost of living pressures and falling interest rates is likely to be stimulatory for the housing sector through the second half of the year, an outcome that's likely to be met with a mixed response from homeowners and non-homeowners. Of course, you can follow all the latest updates in the housing market from the CoreLogic website.